Gautam Duggad is with us, Head of Research Institutional Equities at Motilal Financial Services. Gautam, good morning. Good to have you with us here. Thank you very much for your time. You know, we are, of course, at the cusp of another earnings season. And I was reading the story it was a money control story, and that kind of aggregated earnings expectations from, you guys, Motilal, and a bunch of others as well. And what they're pointing out too is that earnings growth expectations for this quarter are perhaps one of the lowest that we've had over the last 1 year or so. We've kind of seen some earnings cuts, etc., going into the earnings season as well. Just wanted you to contextualize that. Are we starting to see a deceleration in earnings growth, or is it something else? Go on, Gautam.
Hi, Prashant. Good morning. So two different points there. First of all, you have to look at the context of what happened in the first 9 months. The first 9 months earnings growth in Nifty was 26%. And we had expected sub 10% kind of a growth in fourth quarter, because we had done the 4-quarter split right at the beginning of April, as we always do last year. So this quarter 6% growth, therefore looks a bit softer. But you have to look at the nuances behind that. Number one, it's being dragged down by commodities, which is metals and oil and gas. So for my coverage, if you remove these two sectors, the growth is about 12%, right? If you look at the similar number for Nifty without commodities, the growth is about 9-10%. So yes, versus the first 9 months, it looks a bit soft. But also remember that for the full year, you are ending at 21% earnings growth, EPS growth for Nifty. Next year, we are expecting about 14-15% kind of an earnings growth number. So there's 980 rupees of EPS that we are building in for FY24, which has been pretty stable, by the way. There's been no cut for the last 7-8 months now. We were around similar 974 number in October 23, and now we are at 980 rupees. So broadly stable for FY24. FY25, we are down from 1130 to somewhere close to 1120. So marginal 1% cut. Now, if you do 14-15% growth even next year, then this will be the first time after a long time that for 5 years in a row, you're talking about a double-digit earnings growth. Because last 4 years, between FY20 to FY24, Nifty earnings have already compounded at 22%, from 3.4 odd lakh crores to somewhere about 7.8 lakh crores. And if you look at a broader market and look at our coverage universe of 270 stocks, we are talking about a compounding of 27% between FY20 to 24, right? From about 4.3 lakh crores to about 11 lakh crores this year. And our expectations for next 2 years for our coverage universe, the broader universe, is about 16% compounding for next 2 years, from 11 lakh crores to somewhere close to 15 lakh crores. I would say, quarterly fluctuations aside, earnings momentum for corporate India is very solid. And like we mentioned in our report, it almost feels like a mini-Goldilocks, because macros are fine, earnings growth is fine. So yes, this quarter is a bit soft because of commodity, but otherwise the trend is quite intact.
Okay. Gautam, hi, good morning, and thanks for joining in. I have to ask you your view on what's happening with the rise in gold prices, right? In so many years of tracking the markets, I've never seen a time where gold is rising like this, at a time when equities is also surging. But it also speaks about how the power play is perhaps seeing a tectonic shift away from the west to the east, with China buying so much gold to hedge against the dollar. What does all of this mean for an equity market investor?
So Sonia, it's futile to predict, the commodity prices. This is one thing I've learned in the last 17 years being in markets. Whether it's gold, crude oil, metals, you just cannot predict it. Yes, it is a bit, unprecedented that you are seeing equity markets at a new high. Gold prices are doing well. At the same time, the 10-year yields of US have risen also. And there is a potential discussion on rate cuts timing. So not everything adds up, right? So at some point of time, something has to give away. Now, a job of an investor, especially equity market investor, is to look at investable ideas in investable sectors. You can discuss, where the gold prices are going or where the crude oil prices are going, but the probability of you getting that right is next to zero.
Gautam, my question is more to do with asset allocation, right? A lot of people are having this missed out feeling, left out feeling in this gold rush. So what is your advice to them? Does it make sense to still buy at these levels, or just, stick to plain old equities? Because a lot of the buying that you're seeing in gold could also be speculative.
So, Sonia, all I can say is one should have a very diversified asset allocation based on one's risk profile. My unfortunately, my expertise on gold is very limited. Yes, we do like some of the plays on the gold in the listed equity space, which is where we have a very bullish view for last 10, 12 years. It's part of our model portfolio too. But from an individual's asset allocation perspective, obviously he or she should have some gold in their portfolio. But beyond that, it's going to be very difficult for an equity market guy to comment on that.
Gautam, morning. Rima here. This entire recovery or the continuation of strong earnings growth is also predicated that consumption picks up at some point of time, right? Is that a big risk? Because consumption has been lagging, rural has not picked up as of now. When do you expect consumption to pick up, and will that be a big risk to monitor? And also a little more on commodities, because commodity prices have started going up.
So two things, Rima. First of all, next year's growth is not predicated on consumption picking up. If I give you the numbers, next year's 16% growth, roughly 50 to 65% of, or rather two-thirds of the incremental earnings are coming from three sectors, which is financials, metals, and metals is obviously rebounding from the low base, so it's a bit of an optical element coming into play. And then you have some recovery built in IT, right? So consumption per se, we are not expecting any big up move, at least in staple companies' earnings. In fact, our own estimate for staple earnings next year is somewhere about 8 to 10% earnings growth, which is way lower than what we are building in for the index. When does consumption revive? There are two aspects to look at it. Consumption is a very broad ocean, and there are multiple subsegments. Some of them are doing exceedingly well, things like hotels, things like discretionary names and jewelry and all. They're doing phenomenally well. What is lagging, however, is the low-ticket consumption item, right? Which is staples, the home and personal care and things like that. Now, for that to recover, there is a requirement of 2-3 things to happen. Number one, the monsoon needs to be normal, which is a good thing because there's a prediction that this year's monsoon is going to be normal. Point number two, inflation needs to come down, which is also happening, by the way. So inflation prints are coming off. And third, this is a hope that the political spending in the forthcoming elections, which at some point of time with a lag of 6-7 months, will propel consumption at the bottom of the pyramid. So if I remember well, 2019 general elections, the total political spending as per various estimates was about 60,000 crores. It's fair to say that this year it should be closer to 1 lakh crore. Now, that kind of money trickling down will obviously take some time before it reflects in the numbers of consumption companies, but that's a hope. Because this stocks, this volume growth, top line growth have been lagging not just for last 2-3 years. If you look at the last 10 years data of consumer staple companies also, hardly 1 or 2 consumer staple companies have been able to compound their top lines at 10%. Most others have compounded at 6-7% top line growth. I'm not even talking about earnings. So top line has been very, very lackluster for almost a decade now. So that's a hope. But from our point of view, we are still very, as far as our model portfolio is concerned, we are completely positioned towards discretionary consumption. So out of the 9 stocks that we hold in model portfolio, 8 are discretionary in nature. There's just one consumer staple company.
Got that. Gautam, just to come back to metals, right? Not asking you to predict prices, impossible to do. And of course, the old adage, right? Metals are best bought or sold at extremes. Actually, on the selling side, tough to say when it's at an extreme, but easier on the downside. Now, of course, they're not at the lower end in terms of valuations or anything. But and I know that I think Hindalco is part of your model portfolio. But I wanted your thoughts on Vedanta here. It's actually 2 names, Vedanta and Hindustan Copper, if you have. I'm sure you've looked at the business. Vedanta, of course, is a play on a variety of commodities, but also it's been going through a fair bit of turbulent phase. Hope, of course, always has been that they're able to sort those issues out. So it'll be able to realize its full value. Just your thoughts, Gautam.
So, Prashant, unfortunately, I won't be able to comment on individual stocks now as per the revised disclosure norms. Any which ways, Hindustan Copper, we don't have a coverage. But to make a broader point on metal space, just remember, Prashant, that when we are talking about next year's earnings growth of 35%, our numbers for Nifty metal companies, including Coal India, the profit number is somewhere close to 72,000 crores. This year they will do 53,000 crores. But do remember that this 72,000 crores, if it is achieved in FY25, it will still be 30% lower than what the metal profits were in FY22 when they hit 93,000 crores. So there is some element of, as I said, optical illusion built into it. And there is also a fond hope that the global economy will show some recovery, especially China. Because when you talk about metals, obviously the big elephant in the room is always China. So that is our expectation that there will be some recovery in metals profitability, and which is why we've raised allocation on metals in our model portfolio from being underweight for last almost 9 months to now being neutral.
Okay, all right. By the way,